Hello and welcome back to our second video lecture series dealing with financial accounting. In this chapter, we're going to talk about Chapter 8, which is accounting for receivables. Now, we've seen this thus far, right? We've seen receivables. We know how to book an accounts receivable. We know what it is, right? So in this chapter, we're going to take a deeper dive into accounts receivable. So hopefully by the time you complete this video, you should be able to define what accounts receivable are. Actually, even before this video, you should know what accounts receivable are because we already booked them, right? Way back when we had, Chapter 2, I believe, we were providing services on account. And then in Chapter 5, we were selling merchandise on account. So we've seen accounts receivables. But what we haven't seen yet are losses from uncollectible accounts. And we haven't seen the allowance method of accounting for doubtful accounts. Now, before we start this video, you should already know what these definitions are because they were part of the study guide. So let's go ahead and just kind of dive right in and look at accounts receivable. So accounts receivable, again, a current asset, right? What does it result from? Well, it results from either us providing a service or selling merchandise on account, right? On a credit basis. And we saw that, and a lot of this should be review because we know already how to record a sell on account. We debit AR, credit sales revenue. Once that customer then pays us, we need to credit the cash. We need to debit the cash and credit the accounts receivable. And that transaction there says that, hey, we record the collection of cash from a customer, right? Nothing new here. However, we need to look at losses from accounts receivable, right? So businesses, they are going to extend credit to various customers, right? Why? Well, it makes sense because cash only policy limits our sales volume, right? We're only going to sell to you if you have cash. However, if a business decides to extend credit to their customers, they can in fact increase their sales volume, okay? So businesses recognize this, okay? I can get more sales if I offer credit. And they also recognize that, you know what? There is a very high probability that I will not collect 100% of those receivables, okay? So as a result, we're going to have credit losses, right? Credit losses result from us extending credit and those people not paying us, or us extending credit and not being able to collect on that receivable, okay? These are, in fact, operating losses, right? And in order to account for credit losses, we need to debit what we call the bad debt expense, okay? So that's a new account we have, bad debt expense. It's an expense account, so it behaves just like any other expense account. You increase it with the debit, decrease it with the credit, okay? Now let's look at the allowance method, right? Because we know right off the bat, we're going to extend credit, and there is a very high probability that we are not, or we know that we know for a fact we will not collect 100% of our outstanding receivables, okay? So GAAP comes into play here. GAAP says you gotta make an estimate of your bad debt expense, right? Why? Because it goes back to that whole revenue recognition thing, matching revenue with the expenses that revenue helped generate, right? So any loss on a receivable is a bad debt expense. And because of the revenue recognition principle, we have to match up those losses, okay? Now, the problem is we do not know what the actual amount of the write-off is going to be, right? We don't know 100% for sure how much of these receivables are not going to be collected, right? We have an idea, but we don't know exactly, okay? So what we need to do then is to facilitate this matching principle, right? Matching revenues with expenses says that to facilitate this, we need to use the allowance method, okay? What the allowance method does is it allows us to guesstimate or to estimate the amount of accounts receivables we will not collect on, okay? So we will do an adjusting entry. We have a new account now. It's called the Allowance for Doubtful Accounts. It is a contra asset account, right? What does that mean? Well, it goes against the asset, specifically accounts receivable. Allowance for doubtful accounts behaves exactly like accumulated depreciation behaves, meaning allowance for doubtful accounts is increased with the credit, decreased with the debit. Okay, so let's look at an example here, right? Let's assume that Scripps Company estimates its bad debt expense for its first year of operations to be $5,000. So we guesstimate that out of all of our receivables, out of all of our credit sales, 5,000 of those will not be collected. Okay, what do? Well, it's an estimate. So we debit bad debt expense, credit allowance for doubtful accounts, and this is what we do to record the bad debt expense for the year. Okay, so notice we do it for the upcoming year. So how exactly do we report this allowance for doubtful accounts? Well, remember, the allowance for doubtful accounts is in fact a contra asset account. So that means we increase it with the credit, decrease it with the debit. Okay, what we do is we take that allowance account allowance for doubtful accounts, and we subtract that from our accounts receivable gross amount. So if you'll notice in a slide, we have accounts receivable, $14,000. That's the gross amount of accounts receivable. We already estimated that about 5,000 of that is going to be the allowance for doubtful accounts. That's going to be the bad debt expense. The difference between those two is $9,000. So what is our accounts receivable net? It's $9,000. Okay, so eventually we will be able to write off specific accounts. A time will come when we say, you know what, this person hasn't paid us for 2 years. There's no chance we're going to collect, right? So what we can do is we can write off a receivable when we deem it to be uncollected. Okay, we say there's no way we're going to get paid from this person. Why? Because we know that this person or this company declared bankruptcy, or they ceased to operate, they went out of business, or they just hate us and refuse to pay the bill. Okay, so we need to write it off. So keep in mind that when we write something off, it won't affect either expense or total assets. Okay, why? Well, because we already accounted for that, right? We already accounted for the accounts receivable. We already accounted for the allowance for doubtful accounts. So when we write off, we are not going to affect either an expense or total assets, right? What we need to do, we need to clean up the accounts receivable account. That's all we're doing, right? What about the expense? Well, the expense occurred at the time that we estimated that allowance for doubtful accounts, not at the time of write-off, okay? So let's assume for a moment that $200 of outstanding receivable is determined to be uncollectible, right? This person went out of business, they're not paying us. What's the journal entry? Remember, we're not recognizing an expense here. We are cleaning up the accounts receivable account. So what we are going to do is we are going to debit allowance for doubtful accounts, and we're going to credit accounts receivable. If I were you, I'd kind of jot that down, right? Maybe on a note card or in your notes or whatever. This is the journal entry you have to do whenever we write off a specific receivable, okay? Debit allowance for doubtful accounts, credit accounts receivable. Okay. So let's kind of review here a little bit, right? What did we do? Well, from the get-go, we said that we got to set up an allowance for doubtful accounts. We said that that's $5,000 because that's what we expect future credit losses to be. It's an estimate, right? How do we recognize that expense? Well, we debit bad debt expense, credit allowance for doubtful accounts. Okay. Later on, we deemed an account uncollectible. $200, there's no way we're going to collect it, right? This is definitely uncollectible. So we need to record the actual write-off. This is how we clean up our accounts receivable. Debit allowance for doubtful accounts, credit accounts receivable. Okay? Now, there may be a time when an account that we previously wrote off actually says, oh, hey, I owe you some money. It's been years, but here's the money I owe you, right? That could happen. So there are on occasions that an account that has already been written off might be collected later, okay? So let's continue with the example that we have, that $200 write-off, right? Let's say that it was actually collected. We wrote it off. 3 months later, they said, hey, here's your check. Wow, we already wrote you off. What do? Well, we don't send the check back to them, that's for sure. We do 2 journal entries. Very easy. First thing we do is undo what we did, meaning we reverse the original write-off, then we collect the cash. Okay? So, let's assume that we have a $400 account. It was written off. However, later it was collected. What do? Well, the first thing we did, as soon as we deemed that to be uncollectible, is we said we're going to write this account off. We're going to debit allowance for doubtful accounts. We're going to credit accounts receivable. Okay? 3 months down the road, we get a check for $400 from this customer. Oh, wow, they paid us. All right. What do we got to do? Well, we have to undo the write-off. That means we need to reinstate the account. How do we do that? We do the exact opposite of what we did when we wrote the account off. Meaning, to reinstate the account, we need to debit accounts receivable, credit allowance for doubtful accounts. That's how we reinstate the account. We got the cash, so now we need to record the cash receipt. How do we do that? This is a no-brainer because we've already done this. Debit cash, credit accounts receivable. What are we doing? We're recording the collection of cash on account. Okay? When we come back in our next video, we're going to look at the percentage of net sales method and the accounts receiving aging method. It's what we can use in order to estimate any bad debt expense. Okay, so tune back in for that one.